Well, hey there, everyone, and welcome to this week's edition of the Roundtable with your host, Don Yocham. And there's the man himself. Boy, I tell you what, Don, it looks like we got some great stuff lined up today. You got some awesome guests. We got some important things to talk about. How you doing today?
I'm doing great, Raleigh. How about yourself?
I'm doing awesome, my man. Awesome, awesome, awesome. It's the middle of the week, hump day. There's a ton going on. So let's call this a pit stop. This is a great place to stop for a moment, ponder what's going on so we can plan our next thought. What do you think?
Oh, that's absolutely right. We had CPI this morning. It was kind of a non-event, right? But before we bring on our guests, I just wanted to quickly maybe show you what I'm seeing building up in the market, right? So that today we're going to talk about. And before I bring him on, we got Roger Scott, Scott Welsh, Jack Carter. I'm calling it my bottoms up special, right? We're going to look at the stock market from the bottom up, see what kind of trades they got. They all have lots of great ideas. And in this vein of that, I wanted to take a look at the S&P 500 and see what I see building up over the long term, right? So we've talked a lot about, hey, is the S&P, we're in this sideways action. How long is that going to last? With inflation coming up, what's that say about the Fed and all that stuff like that? So let me just take a couple minutes here before we bring those guys on to share what I'm seeing. And, it may relate to what we're talking about later on today. Okay, great. So here, guys, what I've got real quick, and many of you guys are familiar with the volume profile here, at least it's a tool that I use, right? And so here we have the S&P 500 futures contract, the E-mini, over the last year. And what this shows you is how the volume is distributed over the last year, all right? So, you've got from this low at 3502, you have very little volume, right? And all the way up to 4327. And what you see is this volume building, more traders, more action, more buying and selling as the prices go higher, right? And so to me, this is a very bullish pattern, right? Longer term. It doesn't mean, next week or today or anything like that, but this is a longer term bullish pattern building, right? And this is finally taken shape over the last maybe month or so. And, you've had this very sideways action with, here's 4,200 that I've been looking at as a very stiff point of resistance. And that's continued since last August, right? And we keep coming up against 4,200 and volume continues to build at that level. Here's what I think, right? And we'll talk about CPI and inflation expectations and all that stuff in just a second. But here's generally here's the headline. I think what we'll have is this: we've got this range right here that still has some volume that could be filled out a little bit. Basically, it's between 4,000 and that 4,200. I think we'll continue sideways here through the summer. Very little happens in the summer usually in terms of market. So we've got this range right here that we're going to fill out. And then in the fall, I think we're looking at much higher levels, possibly 4,600 or something like that, all based on, the way the market is kind of setting itself up to move higher in the longer term. So I just wanted to share that with you guys real quick. And with that, as prelude, why don't we bring on Roger and Scott and Jack? We got you guys here.
Hello,
Hey
hello.
there, Roger.
Hey, Don. Hey, Scott.
How are we doing today?
Doing pretty good. How are you?
Oh, I'm seeing a little tan there, Roger.
Yeah, it's not the tan. It's my camera, actually. My camera is a little off. My assistant's off with a stomach bug, so I can't adjust it today. So you're going to have to look at me the way it is.
Yeah, that's the real unfiltered you, huh? All right. We got Jack? I don't see him on yet.
Yeah, where's Jack?
Scott, how you doing?
I'm doing good. How about you?
Oh, excellent, man. Glad to have you back. And looking forward to hearing what you have to say. We'll get Jack on. I'm sure he'll hop on here in a second, guys. But without further ado, CPI came out this morning. It's basically in line with expectations. The thing that everybody seemed to focus on temporarily, at least the markets temporarily, was the rolling 12-month or over last year CPI. The pace of increase was the slowest at the last 2 years. So like a 4.9% increase, slight cooling. Certainly, I don't think it's all that much to get excited about. But Roger, what do you think? What do you think about? Do you have a view on inflation going forward? And what do you see? How you see this affecting markets?
Well, it's interesting. And let me just share my screen real quick. I just want to kind of give you a quick, if that's okay. It'll just take a second here. Here we go. All right. So here you could see the CPI, and I just want to kind of go through the estimates. What I look and what the Fed looks at is the core, and the core, the headline number is really a no-brainer. It's at 4.9, so it's slightly better. Yep. Ex food and energy, we're right where we were last time, just maybe a hair better. I mean, a hair. So if you want to say things are working, you could say that, but honestly, I'm not so convinced that. I mean, this is not a oh my God, inflation is so much lower. We're done with this thing. I don't see any of that at all, as a matter of fact. And as you all know, this is a very this data lags, and it's subject to revisions. And I don't want to make more of it than it is. That's one of the things that people tend to do with Wall Street. They tend to take data and they tend to they tend to run with it. And there's just nothing to run here. One big takeaway I could tell you is, based on what we're seeing, is that food prices are still very elevated, and they remain at about 7.7% higher than a year ago. That's a major takeaway that I took from here. That doesn't bode very well for the economy. And if you look at the long bond, you'll see that we've been kind of trickling around this low range here. And if we break down further, which I think we will, that's not going to bode well for the tech or those sectors either. So this
because that points to higher rates, right? That's what you're saying.
Exactly. Lower bonds means higher rates, especially long-term rates. And one of the things that I was looking at the 2-year. I was looking at the 2-year. And I wanted to see what kind of a move it would make following today's report. And as you could see, it didn't make any moves at all. I mean, it's barely up. I mean, this is not a big move. So to me, this report just gives me more evidence, when you take it apart, that food prices are inflated. Now, as I said last week, I think we're not going to see higher rates for the next quarter, but not for the reason why the Fed says. I think the reason we're going to see lower rates is because the Fed is scared that we're going to go deeper into this recession or this nasty environment that we're in. They're going to tell you they're slowing down because what they're doing is working, but in reality, what they're doing, if it is working, it's not working all that well, or we're not really seeing clear evidence of it. I mean, I can understand if the numbers were really, really great, but they weren't. They were just barely okay. And I don't want to bore you with all the nuances and all details. I mean, but cost of shelter was the largest contributor to the monthly all item increase. Rise in used cars and trucks, gasoline is still very much inflated. So I'm not. I mean, some food prices like eggs went down, but honestly, I'm not really seeing the rainbow anywhere near here. I'm still seeing
nothing. Looks like we're going back to 2% CPI level that they say that they're comfort with, right? So, and regarding interest, I was looking at the long bond or the 10-year Treasury futures this morning, and I was seeing the same sort of thing. Looks like a higher rates trajectory over the next few weeks, possibly. I find that kind of interesting. That could confirm well with maybe an S&P that's kind of reached its top end of the range over the coming weeks and could back off a little bit. Scott, what do you think? What's your read?
Yeah, I mean, I think Roger's got it right on. I study all the big moves, the big bull markets. That's fun to read those books in my spare time. If you go back to the 60s, the 70s, the 80s, and 90s, and there have been a lot of massive runs, and especially the .com back in 2000. If you look at those, there are so many economic factors, right? I mean, economics is so complex. However, if you look at them, the rates weren't rising through the roof during these explosive bull markets, right? It wasn't going from 3 to 4 to 5 to 6%. And meanwhile, we're having the best bull market of all time. In all of these huge bull markets, you look at it, the interest rates were falling or they were staying put. So I know that we're probably not going to explode upward when we're still raising rates. And it just feels like everyone is so desperate, like the bulls and everyone else is so desperate to get back long that you look at this non-event, like Roger said, and it's like, oh, can we, can we get in now? It just seemed very tepid. I mean, I'm glad it's not worse, but really, I'm going to let the charts probably show me the way. There's going to be tons of breakouts. I have alerts on, 250 growth stocks, and I just let them come in. It's kind of like a noise meter. And it's, if I get breakout, probably two things are happening. Stocks are breaking out, but also the rates aren't going higher. So I'm just waiting to see. I was hoping for a good. It wasn't really that great. I feel like we haven't really learned much from yesterday. I feel like we're all just kind of in the same pattern.
I think what Scott just said was a key word. We didn't really learn much from yesterday.
You're right. Yeah, not a whole lot of new information. Let me before we move on to kind of getting into, you're gonna share screen. Let's see, can somebody unshare, or is there?
I'm sharing. I'll unshare. I'll stop sharing.
Raleigh,
There you go.
There we go. All right. Just a couple things. So this is the way I'm just going over the way the market reacts and what it's saying. Just a little bit more on inflation and that sort of thing, inflation and rates, before we go into the stocks you guys got that you're looking at. But I've covered this with you guys a few times, and this is the Fed fund futures, how they price in. You can look at the options market and you can figure out what's the probability of a rate hike, cut, all that stuff like that. In June, the next meeting coming up in June, let me compare. There we go. Here's what we have. So this was yesterday's probability of staying the same, a pause, right? So this is a pause. Right here in the middle is a pause, and everybody's pricing a pause in June, right? And it's been slowly creeping up, and then it took a pop this morning up to around 86%. So, as far as the market is concerned, the Fed pausing right here is a lock, right? But then over by the end of the year, we've got 75 basis points worth of cuts still priced in. So that disconnect, Roger, what you're saying is, I'm with you. I don't see cooling inflation. There's a lot of it's a chaotic situation, so it can kind of move anywhere in the near term, right? But there's that pressure. In my thesis has been the whole time that they created a big problem, and that problem is not going to be solved easily. And credit spreads haven't even started to blow out. Loan demand. You're starting to talk about credit crunch yet, but you haven't necessarily seen the effects. But the markets, everybody is pricing in this kind of lower path of rates, which would certainly be explain why the S&P is starting to look very bullish. Not that it'll, which means that if they get disappointed, the subsequent sell-off is going to be even more severe, right?
Right.
And there's a couple ways to look at the way the markets are pricing in inflation directly here on. It's called break-even inflation rates between inflation-protected bonds or TIPS and nominal bonds. And here we have over the last. What do we got? Let's see. You can see that these inflation expectations have been steadily moving lower on the 10-year. On the 5-year, they continue to go down, although they creeped up just a little bit lately here. And here's I found this very interesting. University of Michigan inflation expectations, right? So they send out the survey, ask participants what they think, and it actually peaked back in March of last year. So since the last year, those expectations have fallen and now are rapidly around to 3.6%. I guess that's just, I'm saying it's a very confusing picture out there. The market is really pricing in lower rates, and I don't know that I agree with them, but we'll see where that goes. Anyway, that's what I wanted to share right there. Oh, here we go. Jack, how are we doing?
I'm doing good. How you doing, Don?
Hey, Jack, how are you?
I'm doing excellent, man.
You, Roger?
We got Roger back from sunny Puerto Rico. And we just finished up talking about inflation, and now we're going to move on. We're going to actually, Jack, before we move on, any comments you got on CPI this morning, the release, rate trajectory? What do you think that means for markets? Anything you see?
I don't see anything.
Nothing new got this morning, right?
I'm blind and deaf right now.
Right. Well, fair enough. Or you're paying attention to the right things. I mean, that could be good too.
Is the thing about it is it Powell looks in the rearview mirror all the time. You know, he's got to have some kind of forward-looking thing to add to his lens. You know, the guy's a problem, really, and it's unpredictable what he's going to do. And you know, he's trying to just get a hold of one thing, inflation, and that's like trying to, you know, just grab at one thing when you got all these other things around it. You know, and so I'm done with all that. I'm done, like I said last week.
So he's kind of in like one of those
You gotta
dollar
love Jack.
wind, you know, those chambers where they give dollar bills flying around, and he's trying to grasp at them, and you can't focus on any of them.
No, I'm done with it. I'm making it easier on myself now. I'm going back to what I was doing before, which is, you know, not sticking my head in the sand, but keeping my eyes out of the paper and my ears off the TV and the commentary, because nobody knows. We are in such uncharted water that
100%.
You know, this market we have right now, you know why it's not moving? Because nobody knows what to do.
Yeah.
They don't know where to go long, where to go short. They don't know if they're on foot or on horseback. And
It's the most confusing. It's the most confusing economy I've seen in probably 30 years. I mean, it's something. I mean, I agree with Jack. I watching all that stuff makes me dizzy.
Does make me dizzy. And here's the thing that really makes me dizzy. You know, we got exactly 3 more years of Powell.
Oh God! You had to say that, didn't you? You had to ruin my morning, didn't you?
So, you know, I react now. You know, this reminds me of my days boxing. You didn't have any film on a guy. You didn't know you couldn't predict what he was going to do. You just went in and had to react to what he was doing.
Yeah.
You know, to your thing relative to what he's doing, reactionary. That's how I'm doing it. I'm not believing anything I read anymore. These guys don't know anything. Like I told you last week when I was on Barron's, which I canceled my subscription, they got one article saying that the S&P is going to test it, break through its low, and you turn the page and another guy, maybe even the same guy's talking about how the S&P is going to hit a new fresh high here in June or July. I mean, man, I can get that kind of crap from my grandson. I don't need professionals, you know, this.
You know, Jack, I was reading Seeking Alpha the other day. I like Seeking Alpha, and on the left side there was an analysis. The first article was why AMD's going higher, and the second article right below it was why I'm selling all my shares in AMD. No, I swear to you, I almost took a screenshot of it. I've never seen anything like that.
Me neither. Yeah. Never seen anything like it. These guys, you know, the papers don't know what to publish. People don't know whether to look at the debt ceiling. What a joke that is, Raj. Yeah. You tell me, you know, everybody on here knows they're going to resolve this thing. There's no way they're going to let this debt ceiling rock the market any more than they're already rocking it. What do you think? They're going to resolve the debt ceiling?
Of course it's going to be resolved. That's why I don't get into politics. They do the same thing every time. They make a big news. They make it sound like it's coming to an end. The world's going to, and then the last minute, it always gets resolved, and it always happens.
Or 1 a.m. when they're eating pizza, they finally say, let's raise that debt limit.
That's exactly it.
We've drug him along long enough. We string him along long enough. Let's actually look like we're doing something for our jobs. Yeah. You know, I think you know, on that uncertainty, and, you know, just nobody actually has any conviction, right? I mean, you've got so many factors, right? Not only you got the Fed and the unpredictability of inflation, and then you've got, you know, kind of ESG mandates and what that's going to do to the oil patch. All of that thing is just making anybody with capital to put to work for the long term is saying, I have no idea how to price this, right? And so you get a thing you know, you basically get a market listing around on not a whole lot of conviction, not a whole lot of volume, just a lot of churn. And, you know, but I think that unpredictability is just all over the place. We're not even sure about volatility, right? It's still at low levels. So I hear you on that. Well, with that, then, I appreciate that, Jack. Glad you were able to join us. Scott, oh, no, I'm sorry. I wanted to go to Roger first. Roger, why don't you talk about some of these earnings? So we're coming to the tail end of earnings now. Most of the big names are out, I suppose. You've got some views on revisions and what sectors you think are vulnerable and some other stuff like that. I'd love to turn it over to you right now. And why don't you tell us what you got?
So let me tell you, I took some notes. I want to read you these notes. There's some good stuff here. So about 85% of the S&P has reported so far, and no, it hasn't been Armageddon. It's been actually a lot better than expected. On the contrary, it's been the best in 13 years, according to FactSet. Now, it's so good, not because they're good. It's so good because they've been beaten down with a hammer and a nail about 50 times on their head in the last year. That's why they're good, but they are better than expected. 79% have reported positive earnings surprises, way above the 10-year average, which is only about 73%, and above the 5-year average, which is 77%. Don't get too excited. As I said, they've been beaten down to death. Now, they've become masters at sandbagging, or they've become too conservative. It's one or the other. Nonetheless, this has been an impressive quarter compared to the others. Among the 15% left, we have AI, NVIDIA, which is going to be reporting on the 24th, which is about 2 weeks from now. Importantly, besides the 79 of the 85% that have reported earnings, which itself is a pretty solid number, the magnitude of beats is also very, very high. Initially, analysts have estimated earnings a decline of 6.7%, and so far the decline has only been 2.3%. The report from Morgan Stanley from December of 2022, which felt the analysis was way too complacent for not estimating lower, but clearly, instead of a rude awakening, it was a pleasant surprise to see 10 out of 11 sectors beating estimates. Now, inflation was a positive for companies' top line as well. Revenue beats was as high as earnings beats, with 75% beating estimates, at more than 63, which is what they were estimating, the 10-year average, and 5-year average of 67%. Now, what we can expect for the rest of the year, according to FactSet, which is where I get all this data from in case anybody's curious, bottom-up estimates from analysts suggest third quarterly decline of about 5.7%. They expect a small uptick in the third quarter of about 1.2%, and fourth quarter to come back roaring to the tune of 8.5%. I'm not sure that's going to happen. So I'm really not sure that's going to happen that fast, but there seems to be a lot of money moving in, looking into the market towards the last quarter of the year. Now, this is one of the strongest labor markets in the last 50 years, without a question. Unemployment usually peaks after recessions are over, when interest rates declines have given the economy enough room to rise and start improving. The past recessions have been, or have had, unemployment rates that were much higher. If we were to have a recession, I don't think it's going to be a big one. I think it's going to, because I think we've been in one already, so to speak. I think we're looking at what we saw around 1990, 1991, where it lasted only about 3 months, which wasn't a big recession. Now, let me go ahead and share my screen with you folks here. Looking at, you should be able to, you guys see my screen, right?
Yeah. And Roger,
Okay.
I just, we spent quite a bit of time on that conversation. So maybe I'll give you about 5 minutes or so here, and we got to move on to Scott.
Yeah, no problem at all. That's all no problem. Just to show you the sentiment on the index right now. If you could look at you'll notice that most of these, the 50-day and the 20-day, these are the swing trading oscillators that we use. You'll notice that most of them, aside from consumer staples, which is my favorite sector right now, most of them are at or below the 50-day moving average, which means there's less. That means stocks are trading lower than higher, which is also telling me, when you're seeing this, but you're seeing so many stocks near all-time highs, you're telling me that that there's very few stocks really driving the market higher, and that's a major issue. Now, looking at seasonality, which I'll show you guys right now. All right. This is the seasonality. This is from all the way from April till the middle of May. So you would want to start looking at it right here towards the end, or towards the middle of this chart, or the middle of the range. But just to give you an idea of where we're at right now, let me just bring that up a little here. Here we go. Look at the bottom here. That's the S&P as a whole. You could see here that we're expecting a few days between, say, 10th, 11th, and 12th, which is today, tomorrow, and Friday. We're expecting very choppy, not really up or down, and then it picks up really well towards the beginning of next week, and then it dumps at the end of next week. So we have a lot of choppiness. The only sector out of all the major sectors that's looking really good is the consumer staples sector. And you may notice across the board, across my positions, I'm mostly in consumer staples right now. The other sector that looks really strong is also utilities. But you got to be very, very careful right now with technology stocks, because technology stocks, as you will see, anything that's technology looks very top heavy right now.
Yeah. Yeah. And we saw that this week. We've been kind of on my morning sessions, we've been looking at a lot of tech names, and they're all looking like they're about to turn.
Yeah, if you look at communication sector, it's breaking away from the high. If you look at technology, it's breaking away. Oh, actually, it's not. It's actually still up there, but it's very, very choppy. It hasn't really been moving higher. And remember, earnings for large cap tech are done. And here's what I wanted to say. If you look at SMH, which is semiconductors, which is about half of technology, it's not really looking all that great either. It looks like it's moving back down in a trend. I think what we're going to see is this for the foreseeable future in the market. I know a lot of people are looking for breakdowns, but I think we're going to see a lot of consolidation.
Yeah.
And a lot of choppiness, because that's kind of following what the long bond is doing right now, just being really, really choppy. So I'm not expecting a lot of directional bias. I'm expecting more consolidation, more choppiness, and more uneventful activity for most market participants. The three sectors that I'm really nervous about right now are tech, communication, and consumer discretionary. And one of the reasons, as I mentioned, is because the bond market is starting to get a little bottom heavy. And if that's the case, that's going to increase yield on treasuries, and that's going to push technology lower. That's about all I've got for today, Don.
Well, I think you had some short stock. You had a short list of stocks. To
Oh,
short.
yes. Sorry.
Yeah, come on. I know. I told them you'd give it, so give it.
All right. Here, let me show you the stocks. Let me show you the stocks that I like for the long side. Okay. I like waste management quite a bit. It's been doing very, very well. As you can see, over the last 3 months, it's been doing great. I like Walmart. I think I think people are still looking for bargains. I think inflation is going to stick around for a while, and people go to Walmart when there's bargains. So that's my second stock that I'm really bullish on. Now, the two stocks that I'm bearish on, I'm going to get a lot of heat for this, guys. I'm going to get a lot of heat for this. First one is General Motors. I think cars are a little bit overdone right now. And I think folks are going to be, with interest rates going higher, I think it's going to impact new car sales. General Motors, I think, is going to make a new low. And the second one, I can tell you right now, I'm going to get a bunch of emails for this. Tesla.
I love it.
I'm bearish on Tesla. I think the stock is turning into a dog. And I could talk for an hour. Why? But I'll give you three reasons. They don't have any major catalysts right now for anything they're doing. Their designs are old. They're not new anymore. And I mean, I was in Puerto Rico the other day. I was seeing cars that they don't even have here, that they have in Europe and Mexico, that they're importing there. They've got so many electric cars right now that are competing with Tesla that are brand new. And you're talking about Toyota. You're talking about BMW. BMW just came out with a beautiful electric 5 Series. I've driven a 5 Series for 7 models, 7 generations. And that's just what I drive. And they have a brand new one I've never even seen, and it's fully electric. And I could guarantee you, before I go to the Tesla dealership, I would go to the BMW dealership first. Yes. I'm not ready for electric yet, but I'm just saying that they're not what they were 12 years ago. It's kind of like American Airlines. It's like not American Airlines. It's like AOL. It's like AOL in 1990. They were sitting on top of the world. In 2000, nobody knew their name anymore. It's kind of like, I think that's where Tesla's heading. They're lowering their prices across the board. They're giving people more incentives. They're becoming more desperate. They're not turning into that research battery company fast enough, which is, I was hoping they were going to do that. And their self-driving thing just fell apart, which took a lot of credibility away from Musk. So that's my list for today. And
Roger,
as a matter of fact, what I'll do is I'll also post my extensive long and short list as other speakers are speaking. I'll give you my full long and short list for the next 7 days. It's going to show up in the chat in the next few minutes. Okay, folks?
Awesome. That's great, Roger. Appreciate that. Scott, you had some, you've been getting a lot of emails from people. They don't really know whether they're going to miss out or if they're stuck or whatever. Names can be confusing. You got some ETFs you think that that are kind of some go-tos for everybody. Nice. Keep things nice. Kiss strategy, right? Keep it simple, stupid.
Yes, keep it simple. Can you see my screen okay?
Yes.
All right. We're going to go through real quick because I know I want to hear what's coming right after me. But this is just a long-term view. We've talked about it a couple other times when I've been on, but this is just a long-term view, and I didn't make it up. It's stage analysis. It's a weekly chart. It's the 30-week simple moving average on a weekly chart. Nothing complicated. And the idea is that stocks repeat this pattern over and over, and you want to buy when it breaks out in stage 1, or you want to buy on pullbacks and breakouts in stage 2. Stage 3 is bad. We're going sideways. Stage 4 is bearish. That's it. Okay. Here is an example in real life. Mentioned it last time. Apple makes this, you want to be buying in stage 1 and 2, and then it rolls over. And then it makes a little mini, and then stage 1 and stage 2, and then there's a big stage 2. So that's just, it does happen in the real world. It's not just a funny little graphic. Yeah. And I built an algo. I'm a quant at heart. So I built an algo for this. Really, really simple. And this is if you traded Apple from 95 to 23, that's what the equity curve looks like. So you can actually just put rules on it, use a weekly chart, and stay super calm and not worry about inflation numbers. So here's the real world. Here are some things to consider on the long-term view. This is I buy. Because you mentioned it, what do I buy? What stock do I pick? Well, this stock is going, but I'm going to miss out because this other stock is going better. If you don't know what to buy, if you're confused, that's what today is all about. It is just buy an ETF, put 4, 5, 6 on your watch list, and then just don't worry about individual stocks breaking out. You're going to make some, you're going to miss some, but if you just stick with the ETF, you'll be fine. So here's I buy, which is just an online retail all put together in one package. Back in 2020, when we had a little bit of a problem, it went from 60 to 130, 140. The algo would have bought here, which is 5 closes, 1, 2, 3, 4, 5 weekly closes above the 30 simple moving average. And then you just sell when it closes below, 1 close below the average. So this made a huge gain. You would have only had to watch your chart once a week. But this is exactly the pattern that Stan Weinstein was talking about. Yep. And we're underneath the average. We're ready for a move. So you could just wait for iBuy to get above this average, and you might get one of these, right? If we ever do turn bullish. Another one, same type of thing, SPXL. It's just the S&P 3X on steroids. Here's our pattern. It broke out in the pandemic, made a big gain, and now we're above the moving average. The robot hypothetically would have bought it. So this is kind of a buy right now. You could wait for a breakout above these levels. But SPXL, granted, it's a 3X. Be careful, have stop losses. Don't risk any money you cannot afford to lose, whatever. But this one is kind of ready. Is it going to hit new highs? I mean, it's something to consider. You could wait, again, you could wait for a breakout there. Here's ARK, highly controversial ARK. I know Roger loves ARK. Not really, I'm kidding. But nonetheless, it did make a big gain. It might go to 0. We never hear about it again. But if you happen to like this ETF, it is just breaking above the 30, a breakout above new highs. Maybe we see it run again. Or maybe you like this. This is short ARK. If you hate ARK and you think it's garbage, you buy this ETF when you think it's going to go down. It's a brand new thing. See this rise here? That's when ARK was falling off a cliff. So you could wait for this to break above the 30, which is we're a little bit a ways away from that now. But when this breaks above, ARK is doing terribly. So if you want to bet against ARK, you could wait for this to cross above the 30 and go. Here's online, which is just another online retail. Online retail is going to be big if it ever gets above the average. It's almost there. You can see a big win back in the olden days of 2020. You can see there's the Weinstein pattern, and it's setting up again.
Yeah.
Right now, love QQQ. It's right at the breakout point. We've closed way more than 5 times above. We've broken out above a level. This 320.75. I'm not big on tech personally in my heart, but I'm just showing you what the chart says. Is it going to make another run? This is the breakout level. If you're interested, keep your stop losses tight, blah, blah, blah. If you, though, don't like trading, and believe me, I like trading. I just wanted to bring this. This is buy and hold, which I don't love buy and hold at all. I prefer trading and using a system. Here's QQQ versus the market, SPY since 1999. Total return 628 for the QQQ buy and hold, 384. So you want to time it, maybe you can do even better, but the QQQ just destroys the market since 1999. I thought that was interesting. And here's TQQQ, another ETF, which is the QQQ on steroids. Big run when it broke above the 30. It's now below, and it's again right at another breakout. We've closed 5 times above, and it's at another breakout level. You could get in as long as you keep your stop losses tight and watch your position. But I thought this was interesting. TQQ buy and hold, again, don't love buy and hold, but versus the market since 2010, average total return from TQQ is 37% and the SPY is 12. So if you, I mean, you could, if you don't like trading, it's kind of a good buy and hold level, right? Again, I'm not advocating at all.
Yeah, I don't know if I'd buy and hold a 3 times levered.
Triple leverage,
exactly.
your drawdown
Yeah.
with.
I agree too. But you know, we're here to educate and entertain. So I thought that was entertaining.
There you go. There you go. That's lots of action. Well, thank you, Scott. That's a lot of great stuff, man. You know, those longer term cycles kind of helps keeps it simple. So that's awesome. That's awesome. I'm sure we'll hear more about that indicator you built. I bet there's something there. So that's awesome. Jack. All right, man. Okay. What do you got for us here? I know that
right.
you know, people would love to see what kind of looks good to you right now, but there's a lot of other stuff too. So let's hear it.
Let me try to share my screen.
Mm-hmm.
I got it down here somewhere. All right, can everybody see that?
Yes, sir.
Okay, so I'm looking at this in trend point, and you know, I don't like to predict things, so I'm just going to tell you where we are right now, the way I see it. So these colored bars, a blue bar day is a higher daily high and a higher daily low. A yellow bar day is a higher daily high or a higher daily low, but not both. White bar day is neither. A purple bar day is a lower daily low and a lower daily high. And then I've got these 3 trend points that I use as indicators. And right now, SPY is above all 3. So this is bullish to me. That's what I look at first. What is a broad market doing? Because I like to use a market-driven approach. So if the market's bullish, then I'm going to plan my short-term trades bullish. And here's DIA. Not you know, it's technically it's bullish because it's above all 3 trend points, but it's more of a sideways choppy kind of bullish that could turn bearish anytime. So this isn't that strong. And then I look at QQQ, and this is obviously the strongest of the 3. It's actually trending a little bit higher. It's crossed. We had a crossover right here of the trend points. That's like the most bullish signal in the world for me. So, you know, I've got a lot of NVIDIA, Google, stuff like that I really like. Now I'm going to give you 3 stocks that I like that I just found today. And I use this software because this tells me what the broad market's doing. Then I'm going to plan a market-driven approach. So this is all kind of bullish. So here's what I like. This is BSX. It just hit a new high, and it's got 6 months of a real nice trend. You see this long-term trend point is sloping up. And you wouldn't think we could have this in this kind of market because there's not a lot of follow-through in directional trading, right? So BSX, this has been awesome. And then this is COCO, COCO. We had a crossover of the trend points back here. That's a bullish sign as you can get. And look at that trend, man. I love this kind of stuff. Now, I'd buy something like this and hang on until it just stops going up. You know, that 10-day time frame is kind of my thing. And I like to get in here. If you were going to use a stop, you always want to place it outside. You don't want to put it inside the normal trading range, or you're just going to get stopped out while it's trending higher. So put a stop in here, you know, right around maybe 20 or 7% below your purchase price is a good place for a stop. Never use a stop on options, by the way. So we got Coco, and then we got Toll Brothers. We got a crossover back here. That's like the most bullish signal in the world. It's all 3 of these stocks I'm giving you have made a new high, new 52-week high. I love that. So those are my 3. for you right
Awesome.
now. That's the state of the market as Jack sees it.
Nice, Jack. That's great. Love it. Love it. Promised you guys we'd get a look at some names and appreciate that. Now, Jack, you've got something else you want to share with us, right?
I do. You want to see that?
Because you're steady Eddie, man. You earn income in all markets. You've got, I consider it an all-weather strategy. And certainly for the last few weeks, you're like, I'm just sticking to my screens, man. I'm sticking to the individual names. So what do you got here?
Let me show you what I got.
Yeah.
If I can find it even. Yeah, but before we go, I want to give you this. This is my all-weather strategy. We got this trade going on right now in CMG, where we're short the 1965 put and long the 1960 put. And where is CMG today? Anybody got a quote on that?
Oh yeah. Oh sure. You bet. Hell, hold on a second. I got you.
In other words,
2044.
2044, I'm short the 1965 put. You think I'm going to have that stock put to me on Friday in 2 days? Or you think these options are going to expire out of the money and therefore worthless? Guess. I already know what's going to happen, but what do you guys think?
I think you're going to get paid.
So here's how it happens. Okay. I got that trade that I think is going to turn around $500 every week. That's kind of the way I like to start people off is, try to target $500 a week. And there's no way for me to guarantee any future results, but it's based on this little known income method that I've perfected. And we have a 97% success rate on these trades, just like the one that I just mentioned on CMG. And while anyone is welcome to take me up on this new trade, I'm going to do something very special for the first 100 people that we get in today. And I'll give you a hint. It has everything to do with this $500 right here. That's 5 fresh clams right there, $100 bills. So if you want to be one of the first 100 to claim this $500 prize plus access to brand new 2-step trade I'm just going to post, then all I ask is that you take a few minutes right now and just watch this brief presentation that I just finished putting together. Just go to jackcartertrading.com/RT and you'll unlock the initiative free. This is a trading strategy that I've been using for over 11 years. I at one time had a hedge fund that did nothing but this strategy. And that was back in the day when we only had monthly options. So we really could only do this like once a month. Now I can do the same strategy every week. And it doesn't even matter the price of the stock. So when I say CMG, people, think I can't trade that. It's $2,000. But the beautiful thing about this is you could do it for $500 because the only thing that matters for your capital requirement is the difference between the strike prices times the number of contracts you're going to trade. So this is really cool. It's my favorite strategy. It's the best thing I got going. I got the happiest customers in the world that have this. So if you'd like to learn how to make weekly income, of course, nothing's guaranteed, but go to jackcartertrading.com/RT and watch that presentation. I think you're going to love it.
It's
guys, I would definitely go do that. Right. We've got Jack. It knows how to do call spreads and put spreads. He knows option spreads. He knows credit spreads. You guys got to check this one out.
It's really good
week
stuff.
After week.
It's really good stuff. I really like it. If you don't want to sit there glued to the monitor and pick directional bets, this is a really good way to enjoy the market right now with all this crazy volatility and non-direction. Do it, folks. It's a good way to get in, and Jack's been doing this for a long time.
Long time. As
You've
Uncle
been hearing
Jesse would say, Jack's been trading stocks since Moby Dick were a sardine.
Oh man,
Doug's in that
you've
spread.
heard it from all of us today, right? I mean, we've got this sideways chop. Don't see any way coming out of it, and this is how you just milk it. You just keep milking the market and putting money in the bank.
Yeah, good stuff.
Awesome. So click those links there. Raleigh posted in the chat. Guys, Scott, thank you very much for joining us. Roger, you guys have all been awesome. I know, Roger, you got something coming up here at round 1, so we got to hop. Jack, you're great as always. Love having you on. I strongly encourage everybody to check out Jack's program here. It's important stuff.
Thank you. And Raj, you got a great tan in Puerto Rico. Don't think I haven't noticed.
It's not, you know what? It's not a tan. It's my monitor. My monitor's messed up, but thank you.
Come on. It's okay.
It's okay. You're looking good, Raj.
Thanks, guys. I'll see you all in my VIP.
You need some, I'll send you some aloe vera.
I'm as pale as they come right now. I have to just adjust my thing. But thanks, guys. I'll see
Love
y'all
you,
later.
man.
Have a great
Thanks
one.
for having
Folks,
me on, guys.
sign up for Jack's program. It's worth its weight in gold. Bye, guys. I'll see you in my VIP room in about 15 minutes.
All
Bye.
right. Adios.
Adios, guys. Hey,
Adios.
listen, folks, I'm going to go ahead and grab the screen here just for a second. And
Raleigh, appreciate your help, man. I'm heading out too, man. Thank you very
Thanks.
much.
Thank you.
thanks. Thank you, guys. Awesome presentation. Well, folks, this is the end of this week's version of the Roundtable. I think the guys did an awesome job. You know, when you get a chance to hear from Roger and you hear from Scott and you hear from Jack and you hear from Don, I mean, they're giving you their best takes as to what's going on in the market and some tips on how to take advantage of and maybe plan for yourself some of the things that are going on. Right now, what you're looking on the screen, I'm just going to go ahead and post this here real quickly. Here's the link to what Jack was talking about. When you click on that link, you're going to come to this video here, and you just go ahead and click on this blue button down here, and up's going to come a video. It's a short presentation where Jack is actually being interviewed, and he talks about this new Income for Life program that he's got going on. You get a chance to see what he's up to, and there's also a special offer at the end of that that is pretty phenomenal. But anyway, this is where the link takes you. And I want to thank everybody for coming today. Once again, we do this every Wednesday. Don usually brings in a different cast of characters to once again talk about the market, some techniques that they're using to trade the markets, some ideas that they have. And I looked at it this way. It's kind of like a midweek. I don't want to say correction, but it's like a pit stop in your trading program Wednesday. Just sit back for a minute, assess what's going on, plan what you do want to do for the rest of the week and going into next week. So with that, once again, thank you everybody for coming. Please take advantage of this link right here. It's totally free. Just go ahead and click on that link there, and you'll get a pretty good idea as to what, you know, Jack has been spending an awful lot of time on and what he calls his Income for Life program. So once again, thank you everybody for coming today. I hope you have an awesome day and a great rest of the week. And I look forward to seeing you next Wednesday on the Roundtable. Take care. Bye-bye, guys.